Hey guys, Sema here. So in today's video, we're going to talk about mortgage interest rates and how to shop like a pro online for not only the mortgage rate, the mortgage company, and most importantly, closing costs associated with that mortgage company and that mortgage interest rate. So the topics that we're going to cover in today's video is number one, the biggest mistake home buyers and homeowners make when it comes to picking the right company. Number two, a detailed breakdown, pretty much a roadmap of exactly what you're going to need to know so you're fully prepared to have these conversations and get these online rate quotes without providing any personal information. Number three is a list of questions and also answers that you're going to have ready before you start talking to these lenders. Number four, the difference between an interest rate and an APR rate and why it's so important for you to know what an APR rate is when it comes to comparing the different types of rates that are being offered to you. Number five, which is my favorite, online tools and resources that could give you instant rate quotes. That could give you a comparison based on the specific state that you're in to see what the worst case and best case scenario is when it comes to interest rates and how to really be able to navigate through a lot of the documentations that are involved in the process, like for example the loan estimate. Number six, which is probably the most popular one, is how to protect your credit scores and how to prepare to make sure that lenders don't have to pull your credit and you don't have to provide them with that personal information when it comes to instant online rate quotes. And number seven, which is by far the most important one, how not to fall for these bait and switch tactics that a lot of these companies are still applying when it comes to trying to generate leads or loans online. So one of the biggest mistakes that a first-time home buyer or homeowner can make in the beginning stages is selecting to work with a vendor versus shopping lenders. And let me explain what a vendor is. An online mortgage vendor is a marketing company that promotes themselves online to capture leads and data from clients that they can sell to mortgage companies for a profit. These vendors promote themselves as online research companies, that they have specific algorithms or they have certain partners that they work with or have done the research for you, that they've found the top mortgage companies, the top mortgage interest rates in specific areas based on a specific service like a purchase or a refinance. So let's enter best mortgage companies in Google's and see what comes up. There's 15 total results. 13 of those results are lead vendors that are not mortgage companies, not mortgage lenders, not mortgage brokers, but they're marketing firms trying to capture your data so they could sell them to multiple mortgage lenders and companies across the country. They're saying that they have the highest rated mortgage companies, which sounds great. We don't have to do a search on our end. It's going to save us hours and hours of time, and a lot of us automatically think like this is the perfect option. Now, if you take a look at the disclaimers listed on these companies' results pages, when they say they have the best mortgage companies, mortgage interest rates, or top rated, it's based on the best of the list of partners that are paying them to be on that list. So be very careful on completing these forms because these companies are going to sell your information to multiple companies where you're going to get bombarded with phone calls for the first few days, weeks, to possibly even months. Now, some of these vendors might seem really trusting. Perfect example, Consumer Affairs. You would think that they're designed to provide true unbiased advice, but they, like the other marketing companies, are there to make a profit. They're there to capture your data and sell it to these specific mortgage companies. Now, the only time a lead vendor could make sense is if that lead vendor has fully transparent interest rates integrated into the rate result page that could show you what each one of the companies is quoting you for that specific date based on your specific scenario. Now, even then, that doesn't mean that those rates are the best rates you qualify for, but at least you can see what these rates are while you're still shopping with other lenders. Now, my personal opinion is stay away from vendors, stay away from marketing companies, because at the end of the day, their entire job is to sell your data, sell your leads to their partners, paying them to sell your information. So what's the difference between a mortgage interest rate and an APR rate? So based on consumer finance, the interest rate is the cost you will pay each year to borrow the money, expressed as a percentage rate. It does not reflect fees or any other charges you might have to pay for the loan. An annual percentage rate, APR, is a broader measure of the cost of borrowing money than the interest rate. The APR reflects the interest rate, any points, mortgage broker fees, and any other charges that you pay to get the loan. For that reason, your APR is usually higher than your interest rate is. The closer the APR is to your interest rate, the lower the closing cost. The further apart the APR is from your interest rate, the higher the closing cost. So when it comes to comparing rates, it's really important to make sure that you ask for the interest rate, but you also ask for the APR rate, because the APR rate is going to dictate what that cost is for that interest rate. So a lot of mortgage companies typically like throwing out low interest rates, saying, hey, we have a 2.375 with an APR rate of a 2.5, which could sound better than a 2.6% interest rate with an APR rate of 2.7, but the cost associated with that specific rate is higher. So depending on your situation, depending on your goal, sometimes it doesn't make sense to pay points for the lower interest rate. So it's really important. Compare apples to apples, but base it on your decision on how long you're going to stay in the home for. If you're going to stay in the home for 5 years, maybe the lowest interest rate with points doesn't make sense. If you're going to stay in the home for 15 to 20 years, maybe a buy down rate, which is paying points for a lower interest rate, could make sense. So even though the APR is a little bit higher and there's a higher difference between the rates, that doesn't mean it's a bad program for you. So the first step is really understanding what is your goal, and based on that goal, understanding what kind of interest rate you want to get. But typically during this initial shopping stage, you want to get interest rate quotes that are called par quotes, no points and just the interest rate with the APR. That's what you want to ask for. So now that you have an idea of what the difference between an interest rate and an APR rate is, we could dive a little bit deeper to see some of these reports that are out there that show what the savings is for home buyers and homeowners that take the time to kind of shop lenders and see, based on some of these indexes, what that difference really looks like. So one of the reports that I looked at was LendingTree. LendingTree has put together a mortgage rate competition index, which measures the basis point spread between high and low annual percentage rates, or APR rates, offered to users through the LendingTree marketplace based on all the different lenders that they work with. So LendingTree's key findings pretty much show that in some of these areas, homeowners and home buyers are capable of saving on average anywhere from $69,000 to $74,000 in interest. Now that's a big deal. So another great resource when it comes to shopping lenders is the CFPB, the Consumer Financial Protection Bureau. They're not a lender, they're not a broker, they're not a bank. They're pretty much the police of the finance industry. Their job is to make sure that these lenders, banks, mortgage brokers are doing their jobs correctly and that you are protected. So for the past 10 years, the CFPB has done an amazing job going after these bigger depository institutions, these smaller direct lenders, and making sure that they do not take advantage of consumers and that they're fully transparent with their services so the consumer can make an educated decision. So the CFPB decided to put together an additional tool for home buyers, which homeowners could also use, that gives them a breakdown of what lenders are offering that are reporting to the CFPB on a lowest best case scenario to a worst case scenario when it comes to interest rates. So the lenders in the database include a mix of large banks, regional banks, and credit unions. Now we made sure to include a link to the page in the description below, but if you go in, you'll see that it gives you the opportunity to select a state, a credit score, a house price range with a down payment. Now this, if just in case if you're a homeowner looking to refinance, instead of house price, just enter how much equity you have, so the loan amount pops up, and then you can kind of price it out yourself. If you look to the left, you'll see that the interest rates start at 2.375, go all the way up to 4.125. A lot of times people think that the differences with rates are an eighth of a percentage, quarter of a percent. No, this is the perfect example and the perfect resource that will show you that the difference with interest rates could be all the way up to 2 full points. And you could see on the bottom what the difference in interest would be for 5 years and then for 30 years. In this particular scenario, the 30-year difference is $107,000, the 5-year difference is $30,000. So why is there such a gap between mortgage companies and interest rates? Well, number one, not all mortgage companies are created equal. Number two, not all loan officers that you talk to are also compensated equally. And number three, not all companies operate based on the new school approach of using technology and integrations and resources that eliminate the overall operational cost, compared to the old school approach, which is more based on the human element, people being involved, processors being involved, underwriters being involved, and then additional employees that really bump up the cost associated with originating a loan. So a competitive mortgage company typically compensates their employees anywhere from 0.75 to 1.25% of the loan amount. It could be anywhere from $1,800 all the way to $3,000. Now, why is this important? Because not all companies compensate their employees that amount. There's other companies that compensate their employees 3, 4, 5% of the overall loan size, which, by the way, that margin gets built in for you to pay because the mortgage company isn't paying for it. They have to make up the difference because they have to pay the loan officer for it. So it's really important to kind of understand the differences between the types of companies that are out there and what the individual you're working with is making on your particular transaction. That's why you see such a huge gap. Another reason for the gap is based on the overall cost associated with originating the loan. Companies that use technology usually have a lower operational cost. Now, as a borrower, this affects you because now if the loan officer is making a huge margin and the back-end operation of the company is really based on this old school approach, you're going to be paying a high interest rate. So you want to find companies that are using technology to simplify the process and also have a different compensation structure when it comes to the loan originator. But this isn't something you could dive deep into to figure it out, but you can see it based on how they operate. So companies that have digital, online, transparent solutions like mortgage interest rates quoted to you within seconds, companies that are offering digital online applications that you could complete an application in 10 minutes instead of 4 hours, those are the things you want to look for. And these are the questions you want to ask a company is how do you go about the mortgage application process? Do you offer instant online interest rate quotes for me? And if the answers are yes and yes, now you have an idea, okay, this company is a newer company, they are using technology, and they are providing instant rate quotes, which they're not hiding anything from me, which is super important because anytime a company's like, oh, you need to complete an application first, you need to give us your personal social security numbers because we have to take a look at your middle FICO score to be able to quote you an online interest rates, they're trying to get you to commit for a full application, knowing that 1 out of 2 borrowers don't shop interest rates. But that's not the way to do it. I highly recommend do not give anybody your personal information until they give you a specific interest rate quote, which we're going to get to in a little bit. So before you start shopping, there's a list of questions you need to ask yourself and the list of information you need to gather so you can provide it to these lenders when it comes to trying to get an online instant rate quote. And your social security and date of birth isn't one of them. And your personal documentations are also not one of them either. Now, it's important to know you're not trying to get pre-approved while you're rate shopping. You're just trying to rate shop. You're not trying to buy something to put it on to see if it fits and then go back and return it. You want to be able to see what the price is, try it on. If it fits, great, then you go buy it. So when it comes to shopping for lenders, you want to talk to 2 to 3 different lenders. And I'm going to show you exactly how to find them so you could compare their interest rates and then on top of that, see where their interest rates are based on the industry average. So as a homeowner, here are the list of things you're going to need to prepare so you have the answers ready to go to get instant rate quotes from these lenders, either online through their portals or over the phone. Number 1, the current valuation of the property. If you don't know it, go into Zillow, add in the address, claim the property as your property, enter the basic information, bedroom count, square footage, property type, and see exactly what the average valuation comes back from Zillow. Zillow is not 100% accurate, but they're really good. They're about 97, 98% of where they should be. In some cases it's a little bit higher, in some cases it's lower, but they're pretty spot on. So what I would do just for right now, just to get some comparisons and interest rates, is use Zillow as a valuation report. Number 2, what is your current loan amount? Take a look at your current mortgage statement, have that number ready to go. Number 3, what is the type of loan you want to qualify for? Is it a conventional? Is it going to be a VA program? So number 4, loan term. You want to have an idea of exactly what kind of term you want them to give you an interest rate quote on. So most of us probably took out a 30-year, and you're probably thinking about refinancing maybe to a 25, 20-year. I would ask them for a couple different options. If you have 26 years left on your mortgage, you paid down 4, you don't want to go back to 30 if you don't have to, which I completely understand because the first 5 years of any mortgage, you're predominantly paying mostly interest. But in this particular situation, what I would do is ask them for the different options. Because remember, even if you take a 30-year, you don't have to pay the 30-year payment. You could always apply a 26-year payment or a 23-year payment to pay down the mortgage in the timeline that you currently already have on your current mortgage. So you don't have to go back to 30 if you don't want to, but it's always good to have an idea of what that 30 payment would look like. And when you need it, meaning if you want to pay the minimum payment, you pay it. You want to apply extra and pay it down in 26 years, you can, but ask for a couple different options in regards to terms so you see what makes the most amount of sense for you. And a lot of companies offer what you currently have on a term as an additional option. So if it's 26 years, they'll offer you a 26-year refinance program with a different interest rate. Number 5 is property type, single family, condo. Is it a multifamily home? This is important because there's different risk factors associated with different property types. Number 6, occupancy type. Is it owner occupied? Is it a second home? Is it an investment home? This is really important, and most of the time it's going to be owner occupied. So just have that ready to go. The zip code that the property is located in, of course, you already know it. You have the address and your middle credit score. The Fico score is the most important part to really pull up, which I'm going to explain to you how to get without giving your social security number away to mortgage companies, which when they do do pull your credit, it does affect it anywhere from 1 to 5 points. Now, if you're a home buyer, pretty much the list is the same. The only difference is going to be, instead of valuation, it's purchase price. And instead of the loan amount, you might just have the down payment available. Now, one extra piece to this is really number 9, the closing date. This is really important, guys, because at the end of the day, you want to be able to get the right quote when you're talking to these specific lenders. And most of the times, the closing dates is going to be anywhere from 30 to 45 days. But if the closing date is scheduled 60, 90 days from now, 120 days from now, you want to make sure you give that information to the lender in the beginning stages, because some lenders don't offer 120-day rate locks. Some of them only offer 60 to 90-day rate locks. So those interest rates could change based on the time of the closing. The higher the rate lock, the higher the interest rate in some cases. Some cases, you're not going to see a difference. You might not see a difference between a 15-day and a 30-day, or a 30-day and a 45-day. But once you start going over 45 days, interest rates typically start going up, or the cost associated with that interest rate will go up. So you want to compare apples to apples based on specific closing timelines and rate lock periods. So one of the biggest mistakes home buyers typically make in this situation is they rush the process, or they don't start early enough to really be able to compare lenders. You guys have to remember something. As a home buyer, once your offer gets accepted, that's it. You got to get up and running. And typically, a lot of sellers want you to close within that 30 to 45 day period. Shopping lenders, picking the right lenders could take a few days to really get all this information back. You don't want to be under the gun and really rush the process. And that's what I've seen a lot of home buyers do is, oh, I got my offer accepted. I'm excited, but I have to close in 30 days. So I can't really shop around for a rate or a different type of mortgage company to go through the entire pre-approval process. You want to be able to do this in the beginning stages. So as soon as you get pre-approved by the first lender, I would automatically start shopping lenders at that point. You have time. By the time you find a home, place an offer, get that offer accepted, you have weeks, months, and maybe even a full year. Take your time to find the right lender before your offer gets accepted. This is one of the main reasons a lot of home buyers end up spending 0.5% more, a full percent more, because they're rushed throughout the process as soon as their offer gets accepted. That shopping rates with lenders is a little bit more complicated than they thought that it was, and they have so much that they need to do that they typically just end up saying, hey, I'll just refinance later on, or I'll do it at a different time. But with rates where they are today, I wouldn't take that chance. Now let's talk about credit scores, Fico scores, the different types of bureaus that are out there. This is by far the most popular question that I get asked, and really one of the biggest concerns when it comes to homeowners or home buyers during the shopping process. Now, there's 3 different types of credit bureaus: Experian, TransUnion, and Equifax. And there's 3 different types of credit scores, which is FICO score, the Advantage score, and just regular credit scores that the credit bureaus are reporting. Now, the one that mortgage companies pick is the FICO score. Now, the FICO score also has different types of scores internally based on the algorithms on how the credit bureaus are ranking the type of debt you're looking to take out. So in regards to mortgages, is a very high debt. It's typically the highest balance that you would take out. So the FICO scores are usually lower compared to the different scores like the credit score that Experian, TransUnion, or Equifax could give you on your account that you see every single time you log in. Most of us for great credit will see an 850 on there. But when you get your FICO score pulled, that 850 could turn into 760 or 770, which still means it's great, but the different scores and the different algorithm and how they're grading you, again, it's different. We want you to have the FICO score ready to go. Okay, so if you go to credit.com, you'll see that each credit bureau can have different credit information considered in each type of score model. So what might qualify as an excellent credit score for one bureau might only be considered good for another. The score models can be divided into 3 major types: FICO, Vantage score, and other credit scores. So when it comes to FICO score, what's a good credit score? What's a bad credit score? And where should you be to even consider the process of maybe buying a home or refinancing a home? So most of the lenders out there have a minimum requirement when it comes to FICO score. And some of them are at 500, some of them are at 600, some are at 620, 640, 660. Really depends on the lender's appetite to take risk. And some of the lower FICO scores, of course, have higher risk and higher interest rates associated with them. A rule of thumb is anything over 500, I would start the process to see what lenders are available based on that type of FICO score. But again, don't let them pull your credit. I'm going to show you exactly in a minute how to do this yourself without affecting your credit score, so you could have all 3 FICOs ready to go when it comes to shopping for a mortgage. Now, what is a good FICO score? Exceptional credit scores, especially when it comes to FICO scores, are anything over 800. But anything over 740 that's considered very good, you're typically going to get the best possible interest rates that are available. 740 plus 800, it's all the same. When it comes to good credit, anything under the 739 range to about 670, 680 is considered good. But there is a difference with the rates. And sometimes you're going to see a difference in the interest rate based on a 1 point difference, just like you're seeing here from a 739 to 740. It's considered very good compared to good. So having that middle FICO and understanding how interest rates are graded, the risk factor is graded when it comes to these lenders, is just going to give you a better understanding of how these rate quotes really work. So one of the issues a lot of home buyers always have is, hey, I don't want to shop because I don't want my credit scores to get dinged again, which is completely understandable. Now, the credit bureaus want you to shop, and they want you to shop in a certain period. They don't want you shopping within a 3 to 4 month period, because every single time you wait too long, the credit scores can be affected if you do have another company checking the credit. But what the credit bureaus have given us is the opportunity and ability to be able to shop lenders within a 14-day period. So what I would highly recommend is find the lenders first, get their rate quotes, see exactly who the top 2 to 3 are, and during that time, take an application with all 3 of them. It's a lot easier when you have all the documents ready. You know exactly what questions they're going to be asking you. Just get it done back to back to back. And a lot of times you could even share certain information from what you get from other companies with other companies to make it a little bit easier, so you don't have to go through the entire process again, which we'll cover in a different video. But the most important thing is you have 14 days to shop for lenders without having your credit score affected. Now, before you even get to the point that you're shopping lenders, you're giving them your information, you want to know what your credit score is yourself first. There's a couple different options and a few different companies out there, Experian.com, TransUnion, Equifax, and a free option, which is annualcreditreport.com. So I haven't used Annual Credit Report in a while. I decided to go in and let me just take a look to see exactly what their current client experience is. And what I found out is Annual Credit Report is partnered up with Experian.com. So to get a free credit report, what you have to do is complete the basic information. And it's also going to ask you what credit agencies do you want to pull from. What I would select is Experian, TransUnion, and Equifax, and click Next. Once you click Next, it's going to ask you for credit card information. It's okay. Complete the form. I did it. I entered my credit card information. I entered all my personal information, and my FICO scores came up. Once you complete the full form and you complete the credit card information, you're going to see it's going to give you a portal with 3 different options: Experian, TransUnion, and Equifax, and compare all 4, which is the 4th one. But all 3 of these, what I would do is do a screenshot, save this information for yourself, and see exactly where your FICO scores are again with each one of the credit bureaus. So now that you have all 3 FICO scores, you do not have to give your personal information out to any of these lenders for an instant online rate quote or an over-the-phone rate quote. You know exactly what your credit score is. So you give them this information, especially with the list of questions that we went over earlier in the video, based on valuation, based on loan amount, down payment, property type, occupancy type. With that information and the exact credit score, you can start shopping and talking to these lenders to get instant rate quotes. But now here's what you need to ask from them when you do provide them the information. Number 1, interest rate. Number 2, APR rate. Number 3, the loan scenario itself, the specific detail on the loan, term, and everything else. Number 4, what are the lender costs associated with that specific interest rate and program? We're talking about application fee, commitments fees, processing, underwriting, rate lock fees, points. Number 5, ask them if there's any lender credits associated with the specific program. And a lender credit is a credit that offset those closing costs that the lender might charge you. Some of these credits could be $50, $100, some of them could be a few $1,000s. So depending on the lender, some of them do have some credits that they could apply towards a closing cost. And also the rate lock period associated with that specific interest rate. This is really important. You want to know, are they quoting you an interest rate based on a 15-day rate lock, or are they quoting you a rate based on a 30 to 45-day rate lock because their average turn times is 40 days, or you need 40 days to close? Now back to the loan comparison, you want them to give you a detailed breakdown, just like we were talking about earlier, asking for different options, maybe a 20-year, maybe a 15-year, maybe a 30-year, maybe a conventional compared to an FHA, whatever it is. You want them to give it to you in a detailed format that gives you the option to really be able to compare apples to apples. So here's an example of a loan option comparison that covers, again, rate, term, the name of the loan, points associated, credits associated, what the payment looks like, the total fees, and of course additional details. Now if you click additional details based on a specific program, you should be able to get a full breakdown of what the fees are on a third-party basis, on a lender basis, and out of pocket, especially when it comes to your situation. Is it a purchase transaction? Do you have, is it a refinance? Are you going to be wrapping up the closing costs into the loan? This is where this part gets negotiated. Not 2 weeks into the application process or 30 days right before closing. This is the time that you want to take in the beginning stages to do a full comparison with the interest rates. So now that you have all these fees from the loan comparison, you can start comparing apples to apples and lenders to see exactly what they're offering. And this is the time you really could go back to them saying, hey, by the way, here's a screenshot of an interest rate that I received from another lender. Can you meet it or beat it? This is a really good time to negotiate to see who's going to give you the best possible deal. So you at least pick one company if you're ready at this moment to choose the company you're going to work with. Now, once you decide the companies or company that you're going to be moving forward with, you're going to be completing a full residential loan application, giving them all the information, providing your social security, letting them take a look at the Fico scores, providing them your income information, letting them review the debt to income ratio. There's a lot of information that they're going to need to review on the back end to be able to issue out what's called a loan estimate, a detailed breakdown of exactly what you should expect during the overall closing transaction. And instead of depending on the lender to walk you through what a loan estimate is, what I included is a link to the CFPB, again, the police department of the finance industry, that you could take a look to see what the loan estimate definition is, the breakdown of the loan estimate, and what each section in the loan estimate is for. A lot of lenders will do a good job trying to explain this to you, but there's nothing better than it coming directly from the CFPB, which looks something like this. So as you can see, the most important section of a loan estimate is the top left, section A, which is the origination charges, the lender charges, the points associated, is there an application fee, is there an underwriting fee, rate lock fees. It's great to take a look at this, but as you can see with the CFPB's loan estimate breakdown, which by the way, we've included a link on the bottom of the description for this specific resource, you could select each section and it's going to give you a detailed breakdown of what that section is for. Some of these sections are going to be government fees, taxes based on escrow and insurance. Some of them are going to be title costs, attorney fees, depending on the state that you're in. So what I would do is really take your time, step by step, go through each one of these pages so you could see exactly what the cost associated for the program really is. Now, here's the fun part. How do you shop lenders? Where do you go? Who do you talk to? And what's the smartest way of really doing this? I'm going to simplify this. I'm not going to overcomplicate it because there's so many different lenders out there. And the first step that I would recommend you do is go to Google and type in mortgage companies near me. Your first option should be a local company. And there's a few different reasons for it, but the most important one is because they're local and they work with local AMCs. A local AMC is an appraisal management company that works with other appraisers. One of the biggest issues that clients usually have with working with companies from different states or different locations in the country is that those companies don't have good relationships or partnerships with local AMCs. They typically try to work with national appraisal management companies, which end up doing an okay job, but a lot of times they don't have people that specialize in certain areas that really understand the market itself to come up with a real good value. So what I've seen a lot in the past is complaints, values not coming in correctly, clients not being able to complete their transaction because the value is short. So working with a local lender typically eliminates that risk of not working with the correct type of AMC and has AMCs in the area that really specialize in the area. So that's a really big benefit. Plus they're local. You could stop by, you could see them, you could talk to them in person, and you could feel comfortable that you know that there's a real business that you could drive to just in case there's ever an issue or a problem. The second thing you should do is search for online mortgage interest rates and see what pops up. You're going to see a lot of the bigger banks come up. It's great to work with one big depository institution or one big national lender because at least you'll have an option there, especially if it's not a purchase transaction. If it's a refinance transaction, you have plenty of time to close and you have plenty of equity in your home, that it's not a big risk. It's great to work with a national lender or one of these bigger companies. So type in online mortgage rates and you're going to be able to shop and see what their rates are on their websites, which is great because the bigger companies typically are fully transparent and honest up front and will show you what you could qualify for before you even start the process. So that's what I would do. Take a look at them. The third thing I would do is start reviewing their reviews online. Go to Google. Take a look to see what clients have to say about that specific branch or that specific loan officer. I wouldn't really look at Zillow too much when it comes to comparing lenders and especially on reviews because lenders ask for a review based on a transaction that they know went well for a client to go to Zillow and write a review. On Google, clients go to Google themselves. They Google search the company and they Google search their reviews and they write a review, good or bad. So I would recommend taking a look at Google reviews over Trulia, Realtor.com, or Zillow review sites. And option 3 is broken up into 2 pieces. One, home buyers. Any home buyer that's looking to purchase a home is typically working with a real estate agent. Well, most of you are. See if you can have that agent recommend somebody that they've worked with, that they trust, and that they know will do a good job when it comes to servicing you and getting you the best possible program and interest rate. Now, a lot of times these lenders that work with these agents might not have the best rate, but that doesn't mean with the other two lenders that are giving you quotes, you're not going to be able to start negotiating with them. For homeowners, what I would do is contact the current company that's servicing your loan. You're getting the statement in the mail, reach out to them and see exactly what kind of interest rate quote you could get from them. And then do a full comparison. Take a look at the online lender, the bank, and then the local mortgage company that's in your area and do a full comparison. Now, before we continue, a really important part to go over is comparing apples to apples. You want to make sure that when you do have these three mortgage companies and you are getting interest rate quotes, that you're comparing a quote from today with another quote from today. A mistake that I see a lot of homeowners and homebuyers make is they compare today's interest rate quote from lender B or C with lender A's interest rate quote from 2 weeks ago. Rates change on a day-to-day basis and sometimes on an hourly basis. Sometimes they go up, sometimes they come down. If you're going to really compare apples to apples, the best thing to do is contact all three lenders at the same time, at the same day, and let all three of them give you an instant rate quote based on the same rate lock period as well too. So really big tip, guys, make sure if you're comparing apples to apples, they're really apples to apples and they're based on today's interest rate. One of the final pieces is time to make a deal. You have three offers, three different lenders. Do you just pick the one that gave you the best offer, or do you start negotiating and give the other two the opportunity to meet or beat the number one offer that's on the table? Because you want to work with a company that you do like out of the three options, and you want to give everybody a fair chance to see who's going to give you the best possible rate. So what you do at this point is take the lowest interest rate and send it to lender 2 and lender 3 and see what they could do to meet or beat it. And when they come back with their specific quotes, now you have an opportunity to choose the best rate, or take it a step further, take those two rates. If they're lower than the first rate, go back to the first company and say, hey, I got two lenders that are offering me a super low interest rate, lower than yours and better in closing costs. Can you meet or beat it? And give that first company the opportunity to even do better. And then you have three companies that have given you their best possible rate. You pick and choose the one that makes the most amount of sense, and pick and choose the company that really puts you in a good position to also accomplish your goal, especially if it's a purchase transaction. If it's a refinance transaction, most of the companies are going to be able to get it done. It might take them a little bit longer, but as long as they honor their rate and they don't change things on you, you're going to be in a good position to be able to capitalize and get the best possible interest rate. So now that you have all three of the lenders that have given you their lowest possible interest rates, real quick, go back to the CFPB, take a look to see exactly what their interest rates are based on today, which we went over towards the beginning of the video, and see for what those three rates are compared to the interest rates that are reported on the CFPB. If you guys follow these steps, I promise you, you will be able to be at least in the bottom 2 to 3 of the lowest interest rates being offered for that specific state. So the good news is we have a new video coming out based on the housing market. Is it going to crash, or is it going to continue to go up in the next year to 2 years? Where are rates going? Is now the time to really refinance or purchase a home? So if you're interested in the video, hit the subscribe button below, the notification button, and then give us a thumbs up if you found the information useful. And I hope you guys save thousands of dollars in interest by applying these particular tips, tricks, and really strategies when it comes to negotiating interest rates. But I wish you guys the best of luck. Take care. Bye.